Okay. All right, might get started. A lot to get through today. Welcome everyone. Today's session is all about financial planning and managing your tax as a US citizen living in Australia. There is a double tax treaty between Australia and the US, but unfortunately, it doesn't go far enough to get rid of all the challenges that many of you will face. Today we're going to talk through some of the common pitfalls that we see in looking after our US and Australian clients, some potential solutions to those problems, and also some opportunities that we see in building your wealth as a US Australian living in Australia. So my co-host today is Brad Murphy from Murphy Tax Lawyers and Advisors. Welcome, Brad.
Hi, John. Yeah, thanks for having me today. It's great to be on the webinar today.
Thanks for joining, Brad. And we'll go through some of the formalities to start off. So firstly, the general advice disclaimer that we have to go through. Just confirming that today's session is general. We're not going to obviously talk about any of your personal circumstances in this group setting. We will talk about things at a high level, general manner. And if you're looking for any personal advice, please feel free to reach out to Brad or myself or another suitably qualified professional for assistance after this webinar. Some other housekeeping to go through. So today's session is recorded. So if you need to take off early, that's okay. You'll get a recording sent to your email in the coming days. So it's usually a couple of days after the session. Hopefully later this week. You'll also see a Q&A box at the bottom of your screen there. So please feel free to ask any questions along the way. And we'll leave it a little bit of time at the end of the session to answer some of the questions or as many as we possibly can in the session today. Um, so just to quickly introduce ourselves before we get into the content. My name's John Versace. I'm a director, head of the expat services team here at Up 12 Partners and a senior financial advisor. Up 12 Partners as a firm has been around over 30 years. We have around 85 staff, and we construct holistic financial strategies for our clients. And we're then there on an ongoing basis to make sure our clients stay on track to achieve their personalized financial goals. And we also oversee super and wealth portfolios for our clients on an ongoing basis. We look after around about 3.5 billion on behalf of our clients in wealth portfolio assets. And importantly, we've got a specialist division that looks after individuals that have a cross-border aspect to their affairs. My clientele, the large majority are US Australians. We've got a lot of experience in navigating some of the unique circumstances that all of you on the call face in managing US Australian taxes and financial circumstances. So, Brad, did you want to introduce yourself?
Yes, thanks, John. My name is Brad Murphy. I'm a director at Murphy Tax Lawyers and Advisors. We're a specialized Australian international tax firm. We do a lot of work with US clients moving to Australia or Aussies in the US. Definitely, it's our main focus looking after US and Australian taxes. Feel free to reach out with any questions or comments as we go today, or please drop me an email afterwards. I'm very happy to have a consult with you.
Perfect. Thanks for that, Brad. Getting into the content today. We'll start with superannuation. Firstly, I'll explain superannuation from an Australian tax perspective. Superannuation is really recognized globally as one of the best retirement systems around the world, and you'll see why. So essentially, that the money going into superannuation from your employer is taxed at 15%, or if you make salary sacrifice as a pre-tax contribution, 15% tax on the money going into super. Investment earnings whilst you're in accumulation phase are taxed at 15%, a maximum. And then in retirement, from an Australian tax perspective, if you commence an account-based pension, you have a completely tax-free investment environment with superannuation. So all the investment earnings are tax-free in an account-based pension, so long as your balance is under $2 million. And when you draw pension payments out in retirement, that's tax-free as well. So it's an amazing tax structure. Um, there is an opportunity for Australians to put additional funds into superannuation over and above what their employer contributes. So there's a $30,000 cap each year where you can put, um, including what your employer's contributed, you can get up to $30,000 of pre-tax contributions. For those that haven't met that $30,000 cap and have a balance under $500,000 at the commencement of the financial year, you can also do what they call catch-up contributions. So you can go back previous financial years and use the unused portion of your pre-tax contributions. So as an example, if in the 2024-25 financial year, if you only put 15,000 of concessional contributions, you'd have an extra 15,000 that you could utilize from the previous year, plus what your allowable limit is for the current year. Now, this is an example of how that catch-up contribution can work. So we've got an example of Fred, who is a US Australian. Fred's lived overseas for 10 years. He went back to the US, came back in July 2025, after 10 years of being in the US, and he hadn't been contributing to his super in that period of time. His balance was 375,000 at the commencement of the financial year. So Fred's earning $245,000 with his employer, and he contributes 137,500 because he can go back up to 5 financial years. And because he hadn't been contributing for 5 years, the total of those limits is 137,500. So without that contribution, Fred would have paid $81,288 on his assessable income. The total income tax after that contribution drops to 25,188. And then Fred also pays $20,625 on that money going into super because there was that 15% contributions tax. So the total tax that he would then pay is $45,813. So the saving would be $35,475 in this example. So there's a huge opportunity for those that haven't been contributing in previous years to get a potential tax benefit from contributing into super. But there's some things to watch out for from a US Australian perspective that we'll talk about in a moment. You can also contribute after tax money. So you can put $120,000 a year into your super, or 360,000 by bringing forward the next 2 financial years. So you don't get an immediate income tax benefit on making that contribution, but you get your money into the low tax environment of superannuation, which we talked about is a maximum of 15% typically. Now, that's on the Australian tax side of things. Unfortunately, the US tax system complicates things and makes it a lot harder for you. So the US tax system will tax your contributions, your before tax contributions, as assessable income. So basically, that catch-up contribution I mentioned earlier may assist on your Australian income tax return. It won't assist on your US tax return. The US will just tax any income that you earn and not recognize any money that's going into super to lower that assessable income. There's also a concept called foreign grant or trust. So if you contribute more than what your employer has ever contributed into your super fund, it may well trigger a foreign trust from a US tax return. And that means far more complex reporting and a harsher tax treatment of the investments within your superannuation as well. It's likely that those investments would be taxed in your personal name each year. And then there's look through to see what you actually own within the super fund, and things like managed funds and ETFs are problematic, which we'll go through a little bit further of PFIC treatment. Typically, that's not a problem. If you're in what they call an employee benefits trust, where it's a super fund set up by your employer and you haven't put more than what your employer's ever contributed voluntarily into your super, but with a foreign grantor trust, it is. Drawdown of your superannuation, remember that's tax-free in Australia, but from a US tax perspective, it is likely to be taxable on a US return when you draw your super down. Um, and then a self-managed super fund, again, is likely to be a foreign grant or trust from a US perspective. Um, so again, that complicates the reporting, complicates the tax on the investments. You want a very good reason to trigger a foreign grant or trust, and then consider it very, very carefully because it does come with a lot more complexity on the US tax side of things. So I will say the superannuation treatment from a US tax perspective is um, very grey. The IRS have never come out and said this is how super is to be treated from a US perspective. You'll get different treatments between different accountants. So it is important to make sure that you're aware of how your US accountant is going to be treating your superannuation and what their policy is. And making sure that your financial professionals and anyone that's guiding you on superannuation from an Australian standpoint is in contact with your US accountant as well, because we see it all the time where, superannuation is such a cornerstone of financial planning in Australia. We see a lot of financial advisors that aren't aware of this and are purely looking at an Australian perspective and looking to max out superannuation, and then getting a nasty surprise, unfortunately, when the US accountants do your tax return. So that's what we wanted to go through with superannuation. Just to quickly touch on a few points of how you can think about planning. Certainly, if you're a temporary resident in Australia and you don't intend to stay in Australia, um, superannuation is typically not a great strategy because there is a departing Australia superannuation payment, which is a heavy tax from the Australian standpoint, which likely with them won't offset any US taxes on the drawdown. So that's something that you want to be very, very careful to wait until you're in the Australian system as a permanent resident before you utilize any superannuation strategies. Again, being aware of the grantor trusts with large contributions and a self-managed super fund. Um, if you've got a non-US tax-paying partner, that's an opportunity, which you'll see some other considerations along the session today, that your non-US tax-paying partner might have the opportunity to make larger contributions without the IRS getting involved. If you do have a self-managed super fund, then you've got to be very careful of the investments within your super. So either US domiciled assets or very direct stock portfolios can get around some of the extra complexities that you'll face. And then superannuation rollover, you'll get difference of opinions of the treatment of that with US accountants, but do be careful with that and definitely speak to your US accountant before you do any rollover of your superannuation because it can lead to a tax issue from a US standpoint. Um, all right, so we'll throw over to Brad now to go through US retirement accounts and how they're treated for US Australians.
Yeah, thanks, John. Yes, obviously this is a big topic for either US citizens that are moving to Australia that would probably have a 401k or IRA or even a Roth IRA in respect of their US employment, or even for Aussies that have been working in the US on an E3 visa and would probably have a employer-sponsored 401k. And then would Australia or how would the ATO tax that when you do repatriate or relocate to Australia? Unfortunately, the ATO don't recognize US funds as super, so there's no option to do a direct transfer from an IRA or US fund to your Australian super account. In a nutshell, the ATO would tax the growth or earnings component of a US plan. So that really means that the contributions that have been paid into the plan by your employers or by you personally is the tax-free capital component. then the ATO would say that the growth above the contributions is what you would pay tax on in Australia. So there's probably a few important things to take away from that. First off, having a Roth IRA, which is obviously very common for US citizens to retire taking out tax-free earnings from a Roth IRA. That same Roth IRA would not be a tax-free investment in Australia. So that Roth IRA would become a taxable account following a move to Australia. So normally for US citizens coming to Australia, it's probably not the best investment retirement fund to have long term in Australia. Um, if we're looking at the 401k IRA for US citizens in Australia, um, obviously the US government, the IRS, can tax an IRA or 401k when you take money out from those plans. There's going to be a tax credit for what you're paying to the IRS in Australia, so there's no double tax to worry about with a 401k or IRA. So the goal there really is I guess, to mitigate taxes in both Australia and the US on an IRA. And that's normally achieved by doing like a multi-year type distribution and avoiding taking out a large lump sum in the one Australian year. Because the Australian tax rates are often quite a bit higher than that of America, the goal would be to smooth the tax rates and keep the tax rates as low as possible. Um, the other point just to be mindful of is that the tax treatment is different for US citizens versus a non-US resident. So if you are to set on an E3 visa and leave the US and you become a non-US resident and move to Australia, the tax treaty actually gives taxing rights on a US retirement plan, so a 401k or an IRA to Australia and not the US. So that actually can be quite a good tax outcome. It's a bit, counterintuitive that the US wouldn't tax it, but yeah, that's the way the tax treaties work. So that's really obviously important to get in touch with the right advisor just to navigate that because it can get a bit complex. But it's a nice planning point for those Aussies that are on E3s or temporary visas in America and are coming back to Australia with a 401k or IRA, in that you can actually normally liquidate that plan from Australia and only pay the Australian tax on the growth component of those plans, which is often a fair bit of tax outcome than what you would be in if you're in the US and took the money out from the US. Noting that there's also normally a 10% penalty for taking the money out pre 59 and a half in the US, which can sometimes be waived if you do that from Australia. The other point is that the ATO have actually said the cost basis or the non-taxable portion can be sort of uplifted by doing a rollover from a 401k to a traditional IRA before you actually move to Australia. So probably something to think about for US citizens or even Aussies coming back to Australia would be to do a rollover from a 401k to a new IRA pre-move to Australia. Yeah, there's been some ATO guidance recently saying that that would give you an uplifted cost basis. So the Australian tax would just be on the rollover value increase as opposed to the initial contributions, which is a nice win. Um, yeah, and then we spoke about before, there's no option to move an IRA directly to an Australian super fund, unfortunately. There are ways you can sort of get the money in there indirectly by doing a combination of pre-tax and post-tax contributions, which John touched on before. And that's certainly a very good option for Aussies or yeah, non-US citizens coming to Australia to get money into super quite effectively. If you're a US citizen, obviously there's a bit more care needed if you are putting money into super, given you don't want to create those sort of nasty foreign grant or trust issues that John spoke about before. Yeah, but look, I think in summary, it's a big topic, and we sort of learned over the years through experience, really never a one size fits all approach. It depends on your time frame in Australia. How long do you intend to spend here? Do you intend to retire here indefinitely? Do you want the money in US plans versus just stocks in your own name? So there's a lot of I guess variables in making that choice in terms of how to handle your US plans in Australia.
Excellent. Thanks for that, Brad. And yeah, so it's the Roth IRAs that really tend to cause the far bigger issues, I guess, for
Yeah,
the citizens living in Australia because they're not quite as
yeah,
advantageous. compared to what they're meant to be under US tax law.
Yeah.
Uh,
Yeah,
yeah,
very true, John. It's a bit unfortunate that treatment, but I guess that there are some options there. You could look to liquidate it if you're over 59 before you come to Australia and then reinvest the money. So
yeah,
there's certainly some things you can do. Yeah.
perfect.
Yeah.
Yeah, and then for capital gains tax for a US citizen moving to Australia, did you want to go through how the capital gains tax works, Brad,
Yeah.
and how there's that potential step up in cost basis? Um,
Yeah, for sure, John. Yeah, so I guess the good news for those US clients moving or US citizens moving to Australia or even Aussies moving back to Australia is that you get a new capital gains cost basis on any shares you've acquired since you've been a non-tax resident. So if you're a US citizen with a US brokerage account and you're coming to Australia, the Australian capital gains cost basis will be uplifted to its current market value when you move to Australia, which is good news. So what that really means is that any Australian capital gains tax is only applied from the increase in value of those stocks after you come to Australia, um, which is nice. So in that sense, there's no need to sort of liquidate US stocks or shares before you come to Australia. You can certainly keep those accounts open from Australia. The ATO hasn't got any sort of punitive rules that would stop you from holding US domiciled stocks or shares after you move to Australia. You would still get discount capital gains, so like long-term preferential rates of CGT when you hold those shares for more than 12 months after you move to Australia. So I guess in that sense, it's very similar holding US shares versus Australian shares. So that's probably good news if you're coming to Australia, and it's actually really good news if you're on an E3 or temporary visa in the US and come back to Australia. Because of that rebasing you get, it just means that any capital gains tax in Australia is only from the increase in value after you come back to Australia. And if you're not a US resident, you actually don't pay US taxes on the sale of shares. So it can be a very good little outcome there if the stars were to align. And it's obviously important just to get the timing right to make sure that you do sell those shares after you are not a US resident, and B, you've recommenced your Australian residency from that date as well. Um, the last point in there, the last bullet point, there'll be a foreign tax credit as well to make sure there's no double tax paid. So if you're a US citizen, obviously you're going to keep paying American tax on the sale of shares. There'll be a foreign tax credit in Australia for any American taxes you're paying on the gains. Yeah.
Perfect. Thanks for that, Brad. So passive foreign investment company. So this is a US tax term and relates to assets that are domiciled outside of the US. So this is the technical definition of it on the screen there. But I'll talk about in more practical terms and give you some examples that these assets that are domiciled outside of the US would typically trigger what they call passive foreign investment company treatment on your US tax return. So exchange traded funds or ETF, a very common and popular way of investing. A stapled security. So many won't know what a stapled security is, but that is it's a combination of equity and unit trust. And an example would be Transurban, which is a well-known stock here in Australia. That would be a stapled security. Listed investment companies, which is Australian examples are Argo and Australian Foundation Investment Company in Australia, the two biggest.
Hmm.
Managed fund or mutual fund, as they're known in the US, or real estate investment trusts or REITs, as they're known. And that's companies like Dexus or Goodman Group in Australia. So these are all if they're domiciled and established outside of the US, they're going to be problematic from a US return. And what it means in a practical sense is that there's an extra reporting you've got to do for each of these. So if you've got 20 ETFs in a portfolio that are domiciled outside of the US, there's 20 extra pieces of reporting that you've got to do, which can be quite expensive for your tax return. But then the actual tax that gets applied can be really ugly, and potential high taxes on unrealized capital gains in some instances. But it's typically something you'd want to avoid. So how do you avoid PFIC treatment when you're investing in Australia? So direct company stock. If you were to invest in Telstra shares or Woolworths shares or very direct company stock, they would typically avoid PFIC treatment. US domiciled exchange traded funds. So that means that the actual ETF itself has to be established and do their reporting in the US. So it's not an Australian ETF that is a US market ETF, which is quite common. It has to be established and pay their taxes out of the US. Um, or you could simply invest in the US and open a US brokerage account and own US domiciled investments. So all of those would typically get around PFIC treatment. Now, one important consideration to think about is the currency exchange because we do see a lot of US citizens because of PFIC wanting to then just invest in the US market. And you can understand why, given the restrictions in Australia. But the currency exchange is something that you really need to think about. So if as a US citizen living in Australia, it's likely that your goals and the things that you're working towards are going to be in Australian dollars. And here in Australia, things like retirement, buying a house. Um, so whilst the investment return is going to be very important, um, that investment return in Australian dollar terms is going to be dictated by um, one, the investment performance, but also the currency exchange. And this is an example of what's happened in recent times, or really over the last 30 years or so. And you'll see the volatility that happens in the currency exchange. And the US dollar against the Australian dollar can sit in certain trading patterns for very long periods of time. Um, so it does just add an extra layer of risk when there's currency exchange risk on top of the investment market risk that you need to be aware of. Um, so that's something that we, as financial advisors, help our clients work through of how much do we have in AUD assets and investment portfolios versus what we keep in US dollar portfolios and make sure that we get the appropriate allocation considering everything. So the next topic we're going to go through is investment properties. So I'll throw over to you, Brad, to talk us through this.
Yeah, thanks, John. Yeah, so investment property is also obviously a very popular topic, especially for Aussies with negative gearing. As most Aussies would know, in Australia, there is a very nice tax concession that allows you to effectively negative gear a property, which basically means that the interest on the mortgage is available as a loss to offset your employment income or other income. So it's quite common to actually deliberately have a property that's making losses, and that loss can actually offset your employment income in Australia or other income in Australia, which is nice. Um, Negative gearing can also apply as well if you're living in America. So the losses that accrue on the property while you're a non-tax resident can actually carry forward indefinitely to offset future income when you do come back to Australia. So yeah, obviously a very nice concession in Australia. There's been a bit of talk lately about if that will remain going forward with the current government. So maybe watch this space for now, but as it stands, it's still in place. The US is a bit different. In the US, you can't actually offset a loss from an investment property against your employment income. It's more confined or restrained to only passive income in the US. So it's a bit more restrictive in America. But I think as an overall comment, like investment properties are a good asset class from a tax point of view for US and Australian citizens. There's normally no double tax that's going to apply. Obviously, as an Australian property, you would pay capital gains tax to the ATO if you sold that property. Um, if it's a long-term rate of CGT, it's effectively a 23.5% long-term rate of tax in Australia. There'll be a credit to offset the Australian taxes paid on the American return. The big difference being that there is a 3.8% net investment tax in America. So normally, even though there's a credit for the Australian taxes you pay when you sell the property, you still pay that 3.8% net investment tax in America, which does bump up the effective tax rate a little higher than 23% that you'd normally pay. The other point would be that the 50% discount that Australian residents get is not available for the period that you're a non-tax resident and own Australian property. So just be mindful, it's normally a little more tax effective to be an Australian tax resident and own Australian property, just given you get more discount when you sell the property. And there's also withholding tax that applies if you sell Australian property and you're living in the US, which is a 15% non-resident withholding tax that applies when you sell Australian property. Yeah, so normally it makes more sense to wait till you come to Australia before you buy and sell property if you can. Yeah.
Perfect, Brad. Thank you for that. So now moving on to the primary residence. So from an Australian tax standpoint, the primary residence is capital gains tax free for the period of time that it is considered your principal place of residence, so long as you sell it as an Australian tax resident, which is very important. Um, so you lose that exemption for capital gains tax if you were to move back to the US and sell an Australian principal place of residence from the US and being a non-resident for Australian tax purposes. So if you're planning on moving back home to the US, yeah, it's a very strong consideration of selling the principal place of residence in Australia before you move back, if it's a permanent move back home. There's an opportunity for a 6-year rule, they call it in Australia, where you can still have a principal place of residence considered your principal place of residence for capital gains tax purposes for up to 6 years. So you can rent that property out and still consider the property your principal place of residence for up to 6 years and still get that capital gains tax exemption. You can only obviously have one principal place of residence in Australia at a time, but that allows you to extend that tax-free status for capital gains purposes. A really important point and something that does differ between the US and Australian system is that the interest on a loan against a principal place of residence is not tax deductible. If you've got a mortgage against your primary residence in Australia for an Australian tax purpose, it's not tax deductible, which differs to the US. Now, under the US taxes and how it can really differ for a US citizen living in Australia is that when you sell your principal place of residence in Australia, you would be assessable for capital gains tax because under US tax law, the principal place of residence receives an exemption for up to 250,000 of capital gains per US taxpayer. But anything beyond that is then assessable for capital gains tax. And you have to have owned the property 2 of the last 5 years for that to apply. But even a property in Australia would be assessable for US capital gains tax on sale. So that's something to bear in mind, and is a mismatch between the two systems, unfortunately. Um, the interest may be deductible to you up to $750,000 of the loan. So interest against 750,000 of loan. But the important point is that Australia doesn't recognise that. So under your Australian tax return, you won't get that deduction. So another thing to be aware of for US taxpayers that we see is the impact that a loan against your Australian property can have on your tax return, and it's a bit of a strange one. It's something that can catch people out, but I'll explain it using an example here because I think that's the best way to explain it. It's a bit of a complex one to sometimes wrap your head around. But we've got Jenny, who is a US citizen living in Australia and takes out a $1 million loan against her primary residence in Australia. Now, when the loan is taken out, let's assume that the US dollar and the Australian dollar are sitting at parity. So that means one US dollar equals one Australian dollar. So that means that it's $1 million of loan in Australian dollar terms and $1 million of loan in US dollar terms. And it's interest only. So the loan is not being paid down. Now, in 5 years' time, Jenny receives an inheritance and with that inheritance completely clears that loan and pays it off. So at that time of repayment, the Australian dollar value of the loan is still $1 million, but the US dollar value of the loan is now $800,000 purely because of currency exchange movement. So the Australian dollar had strengthened in that period of time, and the US dollar had weakened. Because of the $200,000 difference in the loan value in US dollar terms from when the loan was taken out to the point of repayment, that $200,000 is often assessable on a US tax return as income tax and is a taxable event. So it's one that catches people out, um, and you've got to be very careful with this. Certainly speak to your US accountant if you are looking at making a major repayment. Also, refinance. So if you're really just moving from one lender to another, that can be a trigger for this as well. And it's purely because of the currency movement where you've received a perceived advantage in US dollar terms, because the loan is less than what it was when you paid it off because of the currency movement. Um, so just be careful with that. And speak to your US accountant if you're doing any major changes to your loan in terms of refinance or repayment. Um, all right, so on to the next topic, estate planning considerations and structures. So over to you, Brad, for this topic.
Yeah, thanks, John. Just quickly on property as well. Just one other point, perhaps, if you've got US property moving to Australia, um, again, like it's a similar concept to the shares. That the US property will get a capital gains cost basis of the market value of that US property when you move to Australia. So again, like any Australian capital gains tax will only be applied from the increase in value of the property after you move to Australia. So normally in that case, from a capital gains point of view, there's no strict need to sell the property before you do land in Australia. But of course, yeah, as John mentioned, it's very important just to keep one eye on the American exemption from capital gains tax to make sure you satisfy that 2 out of 5 year living requirement in the property if you can. If the property is rented, just don't forget to include the rental income from the US property in the Australian return as well. There'll be a tax credit for what you're paying to America to avoid any double tax, but yeah, just don't forget to report that rental property in the Australian return as well. And negative gearing can actually still apply. So if that US property was in fact making a loss, then Australia will allow you to deduct those losses against your Australian income as well. So that does happen occasionally too. If the expenses exceed the rental income from a US property, that loss can offset Australian taxes going forward. Yeah, but back on to estate taxes. Obviously a very big topic for Americans in particular. So far, Australia has not got an estate tax regime to date. That may change going forward, but not at the moment. The US obviously does have an estate tax regime. The current limit sitting at 15 million US per person. Just be mindful that does change every year. But for 2026, yeah, it's sitting at around 15 million US dollars per person. Um, so I guess even though Australia hasn't got an estate tax, it is still important just to recognize that there can be some issues, in particular if you've got an Australian estate that holds Australian property passing to a non-resident beneficiary living in America. That's probably I guess, most complex and biggest issue we see, because holding Australian property as a non-resident can be a bit punitive going forward. There are ways you can mitigate some of those issues by having what we call a testamentary trust under an Australian will. So that's a pretty common sort of mechanism to have this Australian testamentary trust as a vehicle under an Australian will. It just basically means it gives the executor of the estate the option for the property to sit in this trust until such time as the trust or the executor is ready to have the property passed to an Australian resident. That avoids some, I guess, sort of nasty capital gains issues that can sometimes apply. The property goes directly from an Australian estate to a US beneficiary. So maybe have a chat to your estate planner about that. On the flip side, it's quite common for US citizens moving to Australia to have a US trust. It could be a US living trust or revocable trust in the US. They're common for probably two reasons in America. One, to help avoid estate tax issues, and secondly, to make probate a bit smoother. I guess just be mindful that the ATO can say that if you've got a US trust and you're a trustee of that trust and you move to Australia, that American trust could be an Australian trust from that point, which is not normally the best outcome. So I think just be mindful that having a US trust and living in Australia long term is not always the best thing from an income tax perspective going forward. And there's obviously a lot of stuff that could be done to potentially unwind that trust or restructure it before you move to Australia. So yeah, just get some good advice from a good US lawyer before you move down. Yeah, thanks, John.
Yeah, and I guess one of the things that we see that you just got to be very careful of is that in the US, you can move assets from an individual into a trust without a tax issue. So that's common practice. That as part of an estate planning process, as Brad mentioned, you can shift assets from the individual into the trust structure, avoid probate, and it can offer some benefits for the eventual estate there. But the movement of an asset from an individual into a trust from an Australian tax standpoint is a taxable event. So you just got to be very careful to make sure that anyone advising you on the US side really understands how Australia works as well. So
Hmm.
um, going on to company structures, Brad, and family trusts.
Yeah, yeah, thanks, John. Yeah, so on this point here, obviously it's very common for Australian taxpayers to use a structure to hold their assets or run their business. The two common ones are really the Australian Family Trust, which is a very common structure to hold passive assets in Australia. So the family trust is a real vehicle you would use to hold normally shares or investment properties in Australia, or even to run a business in Australia. It's very effective for Australian tax purposes in terms of mitigating taxes, in that you can distribute the income from that trust to a beneficiary that you nominate every year. I guess the US treatment will be different, unfortunately. The US would see an Australian family trust as a foreign grantor trust in the eyes of the IRS, which basically means that the person that's put the money or put the property into that trust is the grantor, and they would pay the taxes on the US side. So that can mean, I guess, a situation where, for Australian purposes, the income's being distributed to, say, one of your adult kids, but for US purposes, the parent that's established the trust is the one that's paying the taxes on the American side. So there is that mismatch there between the two systems. It doesn't mean it can't be used. We still see it a lot in practice and still recommend it sometimes in practice as well. It's just probably more so important to recognize, what it means from a US reporting perspective. The reporting can be a bit more complex than what it would be in Australia, but it still can be used sometimes depending on one situation in Australia. The other big mismatch is the Australian company, the Pty Limited, which is obviously the common Australian company structure to run a business. The benefits would be that you can use that 25% company tax rate in Australia to run your business, which is obviously preferred from an Australian tax perspective. Again, like the US, doesn't really like, most things foreign, so they would see that Australian company potentially is what we call a controlled foreign company, which just means that the person that owns a company can sometimes pay taxes personally on the profit of that company. There's a lot of things that can be done to restructure that so it doesn't happen. You can make a check the box election potentially in the US to stop that. You can have a non US person as a shareholder potentially as well. So there are sometimes things you can do to get around those issues, but yeah, just important to be aware that if you are looking to open an Australian structure, just to keep one eye on the IRS and just to see how they would treat it, because there can be different tax treatments.
Perfect.
Yeah.
So just a couple of last points is that in Australia, there's individual tax returns. There's no option to file as a married couple on a joint tax return. So whose name certain assets go into is really important. It's a common thing that we see that there's a higher income paying person in the couple, and then the investment assets are in that higher tax paying name, and From it, if it was a US tax person and they've got a partner or a spouse, that doesn't typically matter because you're filing jointly. But from an Australian perspective, it does. So you usually have the investments if you can in the lower tax paying partner's name. A trust in some instances can assist with that in terms of the tax planning, but just be aware of the complexity that can cause on the US tax side of things. Uh, the non-US citizen spouse. So we talked about PFIC, superannuation. That's a key way that you can avoid that treatment. Is by potentially looking at the non-US tax-paying spouse and utilizing some of the Australian opportunities that might cause complications on the US tax side of things, using their name. Brad alluded to the net investment income tax, or NIIT, which is a US tax term, and it applies to any realized capital gains and income over certain thresholds. So for a couple or married filing jointly, 250,000, where your income exceeds that level, and then for a an individual that's filing individually, then it's 200,000. So any income or realized capital gains, or investment income, I should say, or realized capital gains over and above that level, then there's this net investment income tax that applies, and there's really not much you can do about it. And unfortunately, foreign tax credits can't be used to offset. So if you've got foreign tax credits available from the taxes you paid on the Australian side of things, it won't offset this net investment income tax on your US tax return. So that's just something that you just need to plan for some extra taxes uh, to be paid. Um, so that's really it. One thing we'll just note as well is that so Brad and I work really closely with some great US accountants as well. So we bring them into the picture, and we've got different US accountants we deal with. So we'll be able to match an appropriate professional for you, or tie in with your US professional where needed. So we have some questions coming through. So in terms of, there's a few questions in relation to 401k. So the first one was that living in Australia now, but worked in the US for many years. If the company goes bust and you're forced to roll your 401k into an IRA, is this rollover possible without creating an Australian tax liability? Brad, did you want to answer that one? Um,
Yeah, thanks, John. Yeah, good question. In short, I would say probably not. Yeah, a pure rollover, without taking a distribution should not be a taxing point in Australia. So, yeah, if the 401k provider went bust or you had to move the money out from the 401k and roll those funds into an IRA, that should not be a taxing point in Australia. So I would say no there.
yeah, and then there's another question in relation to 401k. So does timing matter in terms of rolling a 401k over and other plans to an IRA to reset the cost basis? It seems I could do this before or after returning to Australia to retire. Did you want to?
Yeah, for sure. Very good question. It would have to happen actually before you move to Australia, so before you become an Australian tax resident to get that uplifted cost base. So yeah, I mean, basically the ATO have come out with a number of rulings recently and said we'll give you a new cost basis if that rollover to an IRA happens before the move to Australia, so before you become an Australian tax resident. So yeah, unfortunately, if it happens after you become a resident, then you wouldn't get that same cost base uplift.
Great, thanks, Brad. And then there's a question about inherited IRAs with the requirement to take them out yearly over 10 years. Are they treated like traditional or Roth IRAs? It really depends on the type of IRA in the US, doesn't it, Brad? That if it is if you inherited a traditional IRA, then that is still a traditional IRA. If you inherited a Roth, that continues to be a Roth from the US standpoint, but from the Australian standpoint it really doesn't matter, does it? Because they're kind of treated exactly the same way from an Australian standpoint.
Yeah, exactly, John.
Yeah.
Yeah.
Um, uh, so what changes? if any, should I anticipate when I Aussie US dual marry a non-US citizen partner in the US?
Yeah, that's a good question. I think it would be important to probably think about if we're talking about the Australian partner living in the US, I guess what assets they have, back in Australia, and how they would be taxed going into the US system going forward. Um, Obviously, there'll probably be a change from them re reporting as a single filer or not reporting US taxes to now reporting US taxes. And obviously, they're getting a green card as well. Just some considerations around if they, I guess, if they had a green card or if they're becoming a US citizen, what would that mean long term, particularly if they came back to Australia? But I think as an overall comment, obviously, if you do become a US tax resident, you do have to report any foreign assets back to the IRS. So you've got Australian income from, property or your super, as I spoke about, it's going to be probably reportable in the US going forward. So yeah, I think just it'd be important to understand what US tax exposure you would have on your Australian assets going forward. Not sure, John, if you get any comments.
No, I think that sounds really really good, Brad. But I think from the other side of things, that the if it's a US citizen marrying an Australian that's not a US tax resident, that does not drag them into the tax net of the US.
Mhm.
That might provide some planning opportunities. So
Yeah.
now, can you provide more details or examples of when a foreign grant or trust would be triggered when making non-concessional contributions to an SMSF? An SMSF typically would, and again, I'll premise this by saying that the superannuation from a US tax standpoint is a grey area, so you'll get differences of opinions. But typically, an SMSF on its own would be what would trigger a foreign grant or trust from our experience. So that alone would already trigger that foreign grant or trust treatment. Um, so then any additional contributions won't particularly change anything because it's already met that foreign grant or trust status. So that's I think that answers that one. But
Yeah.
typically, if it's an industry super fund, as an example, um, what we would typically see is that when your personal contributions or what you've voluntarily put in, so not so that your employer's mandated to put in 12% a year. If you salary sacrifice into super or if you put a non-concessional um, contribution into super, if the total of those voluntary contributions that you've put in go over and above what your employer has ever contributed into the fund, that's when it would typically trigger a foreign grant or trust. But again, always check this off with your accountant, US accountant, because you will get differences of opinion. It's frustrating for a lot of people, but it's not the accountant's fault. It's just that the IRS have never come out and given clear determination of how super is to work from a US perspective. And um, we just have to try and apply other parts of the tax act in the US to superannuation. So as a dual citizen, doesn't matter to the US if I am on Australian home loan for primary residence or a grantor or guarantor on a loan without being on the house title. Will this help avoid US CGT when the house is sold?
It's a yeah, good question. Normally it would look towards legal title of the property as opposed to who's a guarantor on the mortgage. So yeah, starting point in both Australia and the US would be who's on the title legally on that home. So yeah, normally if you're not on the title, you're not subject to Australian or US CGT. But I think as John mentioned before, just be mindful of those loan repayment rules that can definitely apply if you're obviously making repayments in foreign currency. Yeah.
Perfect. Thank you for that, Brad. And then there was one question in relation to restricted stock units and how they apply for US taxes. For a US citizen living in Australia, they're receiving restricted stock units. How does that apply between the two countries? Did you maybe want to touch on that,
Yeah,
Brad?
yeah, yeah. Happy to jump in, and maybe you can add some comments, John, afterwards. But If you're looking at yeah, basically receiving RSUs and living in Australia, the starting point is going to be if they're taxed under the employment income tax laws first. So normally with RSUs or employee shares, the country where you're working would tax them under their income tax rules, employee income tax rules first. They basically be sourced to the country that you're working from. So if you have some employment from the US and some employment from Australia, there's likely to be an apportionment of the sourcing of those RSUs. So yeah, first point, just remember you pay income tax first. Then secondly, after you pay the income tax, after there's been a vesting point with the RSUs, if you kept those going forward, they'll be subject to the capital gains laws after that. And that's when any increase after the vesting price will be subject to the CGT rules in Australia. If you actually moved to Australia and had those fully vested RSUs, that's when it's quite good news because you get that resetting of the cost base for the RSUs when you move to Australia. So, just as an example, if you work for, so say, Google, you paid your tax when those shares vested at, say, $100, and you've kept them and moved back to Australia, and it's increased to, say, $400, your capital gains cost base will be uplifted to the $400 value, which is good news. So it can be good news in this case, I think, is the answer. Yeah,
Yeah, perfect.
yeah,
Thanks for that, Brad.
yeah.
And then the last question was in relation to PFIC and superannuation. Just whether PFIC applies to a regular superannuation fund. The answer is typically no. Superannuation, where you've got just an industry or retail super fund, and often it's a balanced option, or you've got managed fund investments within the superannuation. Typically, that won't trigger PFIC treatment unless it is a foreign grant or trust. So the self-managed super fund, or when you contribute into the super fund to trigger a foreign grant or trust treatment, that's when PFIC will apply to your superannuation. And that's when you need to be careful of what is actually invested within the super to avoid that harsh passive foreign investment company treatment.
Mm,
So the direct stocks or US domiciled investments or the US domiciled ETFs within the super.
yeah.
Um,
I've got one more too, John, that's just come through. In terms of having a green card coming to Australia, is there
yeah,
an exit tax to give up the green card if you've held that green card and moved to Australia?
yeah,
Yeah.
excellent. Yeah, did you want to
Yeah, I'll jump
go?
in
Yeah,
first.
yeah, perfect.
In short, maybe is the answer. If you've held the green card for less than 8 US income years, then
Yeah,
normally you can give it up without any US exit taxes applying. But if you've held that green card for more than 8 years, normally you'd be a long-term green card holder, and that's when potentially there could be an exit tax to give it up if your net worth is over 2 million net on a US basis. So I think the answer is probably if you have the green card for more than 8 years and your net worth more than 2 million US, then there might be some exposure that um, you could be a covered expat from that point going forward. Yeah.
yeah, and the 8 years is actually based on having the green card for one day in a calendar year. So if you got the green card on the 10th of December 2022, uh, 2022 counts as one full year in that 8 year assessment. So that's something that can catch people out where it's not full 365 days. It's having the green card in any one day in that year.
Yeah.
Um, so I think that brings us to a close. Any questions that you might have that you didn't get a chance to ask, feel free to send an email through, and Brad and I will see if we can assist. As I say, you'll get a copy of the recording in the coming days. You'll also get contact details for myself and Brad if you want to reach out to us. But thank you for joining today. Hopefully that's helped, and enjoy the long weekend. Thanks so much. Thank
Yeah.
you, Brad, for joining.
Yeah. Thanks, John. Thanks everyone for joining. Have a nice weekend. Bye.
See you later. Thanks.
See ya.
Bye.
Bye. Bye.